Intrinsic versus extrinsic value of an option contract, and why it matters. We'll go over the concepts of intrinsic and extrinsic value, and how they apply to each option. The term intrinsic value refers to the actual value at the time of expiration. When the stock price is above the strike price, call options have real value. Put options have real value when the stock price is below the strike price. In both of these cases, the option is ITM, or in the money. Extrinsic value is the additional value associated with a contract, based on the time until expiration, or the market's expectation of where the stock will go. The latter is known as implied volatility, and you'll learn more about that later. Finally, the closer an option is to expiration, the less extrinsic value it will have. The more fear there is that a stock will make a large move soon, implied volatility, the higher an option's extrinsic value will be. When it comes down to it, option premium is simply the sum of intrinsic and extrinsic value. If we have a call option that is less than the stock price, it has real or intrinsic value because it gives the owner the right to buy 100 shares at a lower price than the stock price. If we have a put option that is above the stock price, it has real or intrinsic value because it gives the owner the right to sell 100 shares at a price higher than the stock price. If we have the total option premium, and want to calculate the extrinsic value, we can simply subtract the intrinsic value from the premium price. If XYZ is trading at $50, a $48 strike call might be worth $2.50. Since the call option must have $2 of intrinsic value, it must also have 50 cents of extrinsic value if it is currently trading for $2.50. A $53 strike put might be trading for $3.25. Because the put option has $3 in intrinsic value, it must have 25 cents in extrinsic value. A $45 strike put or a $55 strike call might have 50 cents in value, but that is all extrinsic because neither option has intrinsic value yet. Options that do not have intrinsic value usually have some sort of extrinsic value because there is still a chance the option will have intrinsic value by the time it expires. The terms in the money, ITM, out of the money, OTM, and at the money, ATM, are used to describe the strike price of an option contract, in relation to the current stock price. ITM and OTM options have different implications depending on whether I am long or short the option. At expiration, ITM options have real, intrinsic, value, whereas OTM options have only extrinsic value. ATM options are strikes that are closest to the current stock price. Remember that ITM does not imply profit, it simply indicates that the option has intrinsic value. OTM options can be profitable prior to expiration even if they never go ITM. If I sell an ATM put for $2 and the stock price rises 10 points, my put is now very far OTM and may be worthless. Which is a good thing. I could buy that put back for less than $2, and the difference would be profit. If the stock price is below the strike price of a put option, long or short, the option is in the money. If I have a long put with a strike price of $60, and the stock is currently trading at $50, that option is in the money, ITM. Because the long put allows me to sell 100 shares at $60 rather than $50. Good thing again. If the option is trading for $12.50, I know that $2.50 is intrinsic value because the option is $10 ITM. If I have a short put option at $40, that put option would be out of the money, OTM. Good thing. With the stock at $50, the $40 put would have no real, intrinsic, value at expiration. The put owner can sell shares in the market at a higher price than the put contract offers. Whatever the $40 strike put is trading for is purely extrinsic value, because it is not ITM, but there is time until expiration, and an assumption that the stock will move from its current price. Extrinsic value shrinks as the time to expiration shrinks. In this case, as long as the stock is trading above $40 at expiration, I would keep the premium I collected up front as profit. If the stock price is above the strike price of the call option, long or short, the option is in the money. If I have a long call with a strike price of $35, and the stock is currently trading at $50, that option is in the money, ITM. Because the call allows me to buy 100 shares at $35 rather than $50. If the option is trading for $15.50, I know that 50 cents is extrinsic value because the option is $15 ITM. If I have a short call at $60, the option would be out of the money, OTM. OTM short option equals profit. With the stock at $50, the $60 call would have no real, intrinsic, value at expiration. The call owner can purchase shares in the market at a lower price than the call contract offers. Whatever the $60 strike call is trading for is purely extrinsic value, because it is not ITM, but there is time until expiration and an assumption that the stock will move from its current price. I would keep the premium I collected up front as profit as long as the stock price is less than $60 when my call option expires. As you can see, the holder of a long option generally benefits when the option goes ITM, whereas the seller of an option, short, generally benefits when the option remains OTM. Thanks for watching. Please leave a comment or question below. Click like and subscribe.